We're going to keep this conversation going with respect to Buffett and welcome in Gregory Warren, Morningstar Senior Stock Analyst. Thank you for joining us here today, Gregory. Just your thoughts. You were listening to Brian here and some author comments about the oil market, some rumblings this morning. How are you viewing equities as we roll into this new week and a new quarter?
Well, first of all, I agree with Brian here. I think that we're definitely going to have Buffett be able to sort of hit some key topics coming into this year's meetings. It happens every few years where we get a lot of large events sort of happening that affords him the opportunity to sort of dig a little bit deeper. The banks is one big issue here. And I think the oil industry as well, to Brian's point, they own a significant chunk of Occidental at this point. My longer term question on Oxy and whether Warren will answer it or not is a different question, but they've got permission to buy up to 50% of the company, but is the long-term game plan here just for Berkshire to just, acquire it whole, and whether or not that makes sense for them in the long run. And as far as equities go, I mean, it's tough. I mean, on their side of the coin, I cover the U.S.-based asset managers, the alternative asset managers, and it's been a tough year in some. I mean, the first quarter ended up being a little bit stronger than our expectations. We were looking for low single to mid single digit sort of gain in the markets. We ended up, sort of, mid to high. Expectation is we're still likely to see, some sort of recession, in the next, 6 to 12 months. And that could have an impact on stocks. And I think, earnings is going to be important. I think the bank earnings are going to be really important to sort of see where everybody is. The regional banks have had a lot of money flowing out. The big money center banks have had a lot of money flowing in. So we kind of have to see where they're situated overall.
Greg, are you surprised that Buffett has not put more of his cash hoard to work in this environment?
Not really. I think he's trying to sort of figure it out, where things lie. I mean, we saw sort of this hesitation during, the COVID outbreak. And I think with the banks, the banks are always tricky because, balance sheet business companies, sometimes you really don't know what you're getting until you get in there. And I think the bigger issue with the banks overall is Buffett is really never going to own, say, more than 15% of any bank, because once they get beyond that threshold, then it changes their reporting requirements, to the regulators overall. And I just don't think that they're going to step into that. I think the key here is, we heard that news break a couple weeks ago about, Buffett talking with the Biden administration and the regulators about figuring out some sort of plan for the regional banks. And it makes sense to me, but I think there's a price that comes with that. Buffett's, stepped in and saved Goldman. They stepped in with Bank of America, but there was a pretty hefty price tag attached to that. You had sort of, anywhere between 8 and 10% preferred stock, and then warrants to buy stock, the common stock as well. So that Buffett seal of approval is not cheap.
And so in the interest rate environment that we find ourselves in right now, and the Fed being extremely clear about its policy pathway with its focus on its dual mandate, what does that mean for the next area that Warren Buffett and Berkshire Hathaway may be interested in setting a larger outsized position?
Well, it's interesting right now because, I mean, you just to sort of continue that point on, why they're not investing more in stocks, they're earning 5%-ish on their T-bills. And their $130 billion in cash that's sitting on the books at the end of last year, most of that's in T-bills. So there really isn't a huge incentive to jump in there unless they can get, a decent return. I'd say probably a 10 to 15%, return out of something with, less risk, overall than they might see in any other environment. So I think, from that position, them sitting on the cash, while we've criticized them, the past decade about sitting on too much cash for a long time, I think sitting on cash probably isn't a bad idea in the near term.
I just want to throw out a statistic from your own notes here that really caught my eye. With the 1.9% yield on Berkshire's average cash in their fixed income investments, their bond investments last year, matching the yield earned on its stock portfolio. This happened for the first time in years. That's really something. Finally, bonds earning the same as much as stocks. What does this say about the environment for Berkshire and its portfolio and, I guess, everything, the merger and acquisitions potential for the future in this environment? Well,
I think the interesting thing for Berkshire historically has been that they've and most people, when they look at an insurance company, insurance companies are heavy into fixed income, and most of their income is coming from fixed income products. Berkshire's been sort of the complete opposite. Most of their income, interest income, dividend income, has been coming from the stocks that they hold, and with most of their fixed income holdings in T-bills, they were earning next to nothing on a lot of that for a long time. So we've seen this huge swing, overall, which has benefited them from that perspective. And our expectation is that's not going to unwind for a while. I mean, I'm not sure the Fed cuts rates this year. And it's just going to be harder for them to sort of step away from the benefit they're getting there. But I think they're also going to be selective about where they're hunting. Valuations have bounced back. Between the fourth quarter and the first quarter this year, it's a little bit hard to get kind of excited about stocks, where valuations are now. They're already heavily exposed on the growth technology side of things. So I don't really see them stepping on, much more, on that side of the market. My feeling has always been, longer term, that Berkshire is an acquirer of more utilities within North America. They're going to be one of the bigger consolidators within that industry over time. What has kept them from doing a lot of deals the past decade has just been valuation, because when interest rates were near zero, utility stocks, REITs, all of these equities that had good sort of dividends on them were basically, fixed income, equivalents for a lot of investors. But now where fixed income, is providing a decent yield with less risk, we're starting to see valuations on utilities look a lot better than they have in a long time. Just not sure if it's quite where it needs to be for Berkshire to get aggressive about buying up some utilities here.
Hey, Gregory, just while we have you, what does that really set up for this earnings season, and especially with regard to valuations that you were just speaking of? I mean, last earnings season, a lot of the story was just around the fact that the margins or the growth expectations needed to be reset, earnings needed to be reset, and transparency needed to pull through. And so now, does that mean that for valuations, much of the worst is behind us, or do you believe that there's still a little bit more turbulence in store?
I still think we're going to have a little more turbulence. I don't think that the worst is quite behind us yet. I think it has to be seen yet what the impact was from Silicon Valley Bank collapsing, and which created somewhat of a mini run on a lot of regional banks, and whether or not that's going to start pressuring regional economies as well. I mean, I think everybody's going to be paying very close attention to earnings this quarter to sort of see what was the fallout, what was the impact. I mean, banks are first and foremost at the front of that, but there's stuff on the asset managers, there's stuff on the alternative asset managers, because they had big exposure to venture cap, private equity investing with SVB overall, and whether or not the disappearance of that bank, and a lot of the relationships that it helped sort of maintain and sustain is gone as well. And then, the tech sector, the question is, how much disruption did that cause within there? I mean, there's just a lot of little things that I think people are going to sort of, want to see what sort of impact this might have had, during the first quarter, and whether or not management teams are, speaking, more cautiously. I think the Fed only raising 25 basis points this last time is probably a good sign that they're closer to the end of the rate hikes than not. And I think we're going to get some management commentary around that as well. Really solid earnings season preview for us as well there. Greg Warren, who is the Morningstar Senior Stock Analyst. Gregory, thanks so much for the time this morning. Thanks for having me, guys. You got it.